What exactly is your mortgage payment made up of? It's not just the loan. Let's break it down. You may hear your lender refer to PITI. That stands for principal, interest, taxes, and insurance. The principal is the money you're actually borrowing from the bank to buy the house. You pay that balance off over a term of 30 or maybe 15 years, depending on what you opt for that best suits your needs and budget. Interest. That's the charge for the use or loan of the money you're borrowing from the bank. That's added to every payment. Taxes. Okay, let's pay a little more attention to this one. Be aware of what the property tax base is in the county you're purchasing in, and ask your realtor what the special assessments are for a home that you have an interest in. When I'm out with clients, I actually have the tax information with me for each home. You may like a home, but when you find out that it has up to $4,000 a year in Melrose on top of your tax base, your interest may lessen. Now, higher taxes don't need to frighten you. Often the really well-planned master communities that have a ton of great amenities, high-ranking schools, newer fire stations, they have higher taxes. But you'll feel every penny is worth it to be in that neighborhood you love. It's really just about proper planning. I always say, know what you're getting into. But back to your mortgage payment. Your property taxes are due in 2 installments a year. The first one is due November 1st and it's delinquent on December 10th. The second is due February 1st and delinquent on April 10th. If you put a down payment of less than 20%, you'll have what's called an impound account. The portion of your payment allotted for taxes and insurance is credited to this trust account. Then the lender actually pays your taxes and insurance for you. One less thing to put on the to-do list in those busy seasons, right? Last is insurance, which is also held in and then paid for from the impound account. Your homeowner's insurance covers for loss on your home from certain hazards like fire or earthquake. The standard policy will pay replacement costs minus depreciation based on actual cash value. You can talk to your insurance rep to get more details on what insurance is available to you. Now, when your down payment is less than 20%, you may also have what's called PMI, or private mortgage insurance. Why, you ask? Well, it's all to do with risk. Loans with small down payments are a bigger risk for the lender, so PMI acts as a protection to them in case the loan goes into foreclosure. Also, be aware that on an FHA loan, there's a fee for mortgage insurance called MIP, or mortgage insurance premium. This is an upfront fee which you can finance, and also a monthly fee is assessed. VA also charges a funding fee which can also be financed. So there you have it. PITI, or principal, interest, taxes, and insurance. Make sure to talk to your lender more about this when getting pre-approved. Your realtor, like me, can partner with you and your lender when you find a home you love to look at the taxes and get an estimate of what your payment would look like before you even write the offer. Do you have a question about buying or selling a home? Please like this video and leave a comment with that burning question you have so I can answer it for you. I'm Katherine Materiale. Thank you for joining me in becoming HomeWise. See you next week.